Okay, let me tell you a little bit about what you're seeing on the chart first, because we got to speak a common language before I can show you how the trade sets up. I'll just go over this real quickly for those that haven't been to one of these webinars before. I've got right in the middle of my chart a 21 exponential moving average. Okay, that's the purple line right here. Why 21? I don't know. There's, on a typical month, 21 active trading days. Forex is a 24-hour market, they say, but it's the most active 21 of those hours, if you add up the Asian, European, and American sessions. 21 is also a Fibonacci number. I could come up with all sorts of good reasons for you, but ultimately it's because I tried the 20 and I tried the 22. And I tried the simple and I tried the exponential, and the 21 in EMA works the most reliably. Very simply, if you're under the 21 and it's aiming down, you're in a downtrend. If you break above the 21 and then retest it as support, and the 21 itself starts aiming up, you're in an uptrend. And you're always either pushing off of, this is why I said retest, okay, because a break by itself is not enough. You're always either pushing off of the 21 or dropping back towards it. And that can happen above it or below it. Okay, one simple line, and already it's added a lot of clarity as to what price is doing. But then we fine-tune that. The lines out here are what are called envelopes. Some trading platforms call them channels. And this very simply is also another set of 21 EMAs. That's why I made them the same color. Okay? Also 21 periods, also applied to the close, also exponential, and then the only other variable you need is what's called the deviation, or in other words, how far from the 21 they are. And I think these particular ones were set by the weekly chart. Yep, looks that way. Okay. These were set by the weekly chart, and if you look at the right-hand corner, this is basically a purely visual setting, you guys. It'll change from day to day. It'll change from time frame to time frame. It'll change from currency pair to currency pair. It might even change from 8 a.m. to 2 p.m. Okay? You just have to keep an eye on it. And basically, you see what I did. I set the deviation so it kind of bypassed the first reversal right between the wick of the candle and the body of the candle. That's all I did. Try a bigger number, try a smaller number, but find the first reversal on your chart and bisect it between wick and body. And look, did a pretty good job of picking the tops up here. Look at the wick over here. It did an excellent job of picking the bottom down here. Basically, the purpose of the envelopes is to give you an idea of what's a reasonable area for the price move and when you're out at extreme levels and very likely to reverse. People often ask me, does this kind of work like Bollinger Bands? Not really, because Bollinger Bands will get wider if you push up against an edge. Well, what good is a limit if it gets wider or shrinks? You see what I mean? I prefer something that stays a fixed distance from the 21 for letting me know when I'm within normal trading range and when I'm out at extreme levels. And that's not a knock on Bollinger Bands. John Bollinger happens to be a friend of mine as well. But you got to use each tool for its intended purpose. John Bollinger started out as an options trader, specifically writing options contracts. To price a contract, you need to be aware of market volatility. That's why the bands expand and contract. It's meant for measuring volatility, not for finding reversal points. Okay? Just FYI. So I prefer a straight band. Envelope, DZ, like I said, it's check your list of indicators on your platform. If you don't find envelope, it might be called a channel, but it's basically the same as the 21 EMA, same settings. 21, close, exponential, and then like I said, the only other setting you need is the deviation. And the deviation is the distance that you simply set by eye. Find the first reversal on your chart and bisect between wick and body. And basically the idea is you mark one reversal, you have a way of predicting the most likely places for future reversals. And obviously if you start seeing a lot of reversals ahead of your envelope, shrink it. If you notice, like this was an exception, but if you notice all the time you're going outside of your envelope, widen it. It's purely a visual setting, and adjust as needed. It's kind of a guideline. It's not ultimately how I pick targets, by the way, DZ. I'll use prior highs and lows. I'll use Fibonacci, things like that. This is more of a guideline for me. If I'm closer to the envelope than the 21 and I get a short signal, well, I'm going to think twice before entering because I'm much closer to the end of the move than the beginning. You see what I mean? Most of your trades are going to be taken from the 21 after a retest, remember, from the other side. But most of your trades are going to be taken out from the 21 out to an envelope, or if you reverse inside an envelope, back down to the 21. Okay? So it's just a way of kind of gauging where you are within the playing field, so to speak. And as you can see, as price moves, the playing field moves along with it. So it's always adjusting to the current situation.